insights and the news shaping this market. Let's go right to Joe Brusuelas, who's here with me at the New York Stock Exchange, chief economist at RSM. Thank you for being here. It's very interesting to see the market's reaction to strength, more jobs, wage growth. That's inflationary. I mean, it's interesting to see the market, how it's reacting. Are you surprised?
Well, I wouldn't say it's inflationary, actually. I think inflation causes wage growth. And right now, what you're seeing is really strong job growth with an appreciation in wages well above inflation. So your American household not only is finding it easier to get a job, their wages are going up, and the wages are going up above inflation. That's one of the reasons why you're seeing the market respond the way it is. And of course, this is year-end data, right? So you look back at 2023 and you say, we added 2.7 million jobs. The average unemployment rate for the year was 3.6%. It finished at 3.7%. That's the sixth best on record and the best since the 1950s.
It's amazing.
Moreover, when we look in the hours worked, Nicole, economists like myself can begin to back this out and estimate where productivity was. Hey, you know what? Productivity increased by just under 2.4% this year. That means Americans' living standards actually increased. This is what you want to see if you're buying stocks. This means, margins are going to expand, earnings are going to improve, and you're going to have a better year than what the first couple days of a very light period of trading in 2024 might indicate.
Yeah, I'm excited for 2024. I think a lot of people are, have some optimism going into 2024. And I'd like to talk more about the Fed, because the likelihood of this rate cut in March continues to drop. I think today it's around 55%. I mean, the Fed seems to be pushing that cut back.
The Fed's not cutting it in March.
Not
they never
cutting
were.
In March,
the market got a little bit over its skis, as it's wont to do from time to time. But we've been very,
When will they cut?
June. Look, the policy rate's too restrictive. The economy and consumption is going to slow in the first quarter and then begin to pick back up. But we're certainly not going to see those gaudy 5% growth numbers like we saw in the third quarter, or what's likely to be a 3% year-over-year growth number in 2023. Therefore, the Fed knows the rates are too restrictive, and they'll have scope and space to bring them down. And they'll do it in a gradual and orderly way, we think, starting in June. We've been pretty consistent with our forecast here, Nicole. 4 25 basis point cuts starting in June. Over the next 2 to 3 years, they're going to get the policy rate down to between 2.5% and 3%. That makes sense. You think about where the 10-year should be, probably between 4 and 4.25 at the end of the year, maybe with a little bit of downside risk there. That's fundamentally good. Moreover, I was taking a look at the quantity of cash sitting in money market funds. It's just under $6 trillion. As the Fed moves to cut rates, risk appetite's going to reignite. You're going to see that cash roll over into markets, right? It's not just going to fuel spending, it's going to fuel investment. Moreover, again, as those rates come down, risk appetite, I think, will really build, and you'll see private equity and M&A begin to pick up second half of next year, and I think 2025 is going to be a massive year in the private equity and M&A world.
So, I just wanted to go back. I mean, so with the Fed, they're trying to slow the economy. Unemployment's likely to rise, right? I mean, that's sort of
a little bit
the whole idea behind it. What I didn't really quite get is about the wages, because I almost thought if wages are higher, that's not what the Fed's really going for. Is that what the Fed's going for?
No, not necessarily.
That's not
but we need to put
right.
this in a context, right? Because this isn't an easy thing to explain. Inflation popped because we shut down the global supply chains in the world. Right? And as they reopened, we got broad disinflation in the goods sector. That's caused inflation to come down without causing an increase in unemployment, even as the Fed hiked rates. The only period of time that was broadly similar was really right after World War II, when the federal government lifted wage and price controls. Now, this time we didn't have wage controls, or price controls, but we shut down the global economy for a defined period of time. Now, as this has worked, as disinflation's moved through the economy, and the Fed rates did cool manufacturing in general, but housing in particular, and housing was red hot and needed to be cooled off. The Fed got something it didn't expect. It got a soft landing without any real increase in unemployment, right? Now, we expect unemployment to increase to around 4.1%. not that much higher than where it is now, and certainly lower than it has been historically. You know, we're going through lots of structural changes. That pandemic permanently altered the economy, and the long-term demographic changes, we don't have enough people here to work. That's really what's at play, and that's what's keeping down, I think, right now. It's what provides the context for where we're at.
Yeah, and I see, I mean, there's jobs across the board, construction, retail. We saw hospitality, leisure within the ADP report, right? Services were doing well. So it's nice to see the jobs being spread out a little bit. You know, I just thought that people were looking for 3.9% for the wage growth.
Well, they were, but remember,
I thought that's what they wanted ideally, so that the Fed stopped with their hike talk.
No, I don't think that's really it. Yeah,
okay.
no, there's some interesting market talk around that.
Yeah.
But from an economics perspective, no, that's not really what was happening.
Well, that's why I love when you're on, because I can ask you the questions that are sort of in depth, like a little inside baseball, you know, and I'm glad you're here. So we'll look for those 4 cuts, 25 basis points each, and you've been on that page for some time. It's great to have you, Joe Brusuelas.
Good to be back. Happy New Year.
Thank you. Happy New Year. RSM's Joe Brusuelas.